Mark Selby. How are you, sir?
I'm very good, Mr. Matthew Gordon.
Okay, so you are speaking from a hotel room somewhere in DC, the center of the universe, some would think and say. What are you doing there?
Yeah, so this is the last leg of a Indonesia, Japan, and here in Washington, D.C. at the Benchmark Conference, which is their big annual Gigafactories conference and sort of their big one. So I saw Joe Manchin speak yesterday, but last night was I think really underscoring just how important this is. EV supply chains are politically. There was a handful of companies that were invited to the Treasury Department of Treasury with four senior administration officials who basically, we had a conversation around, what could the administration do to help, get our projects moving along and help in general, help the mining industry, deliver more raw materials that they need. I was very proud of the fact that we were the only Canadian project that was there. So, I think it's good to be on the right radar screens for sure.
What's prompted this? Why now? And what is the extent of what they were? I imagine you can't tell me what they were offering or talking about, or maybe they weren't. But what's the sort of nature of that conversation in terms of how does the U.S. government think it can help industry?
Yeah. So again, the Inflation Reduction Act had a whole series of things in terms of providing incentives, sort of across the supply chain to help move those parts of the supply chain into the United States. In addition to the companies, there was a senior banker from one of the big banks and a senior market research firm from one of the big global market research firms, and it was very much around we've put in a series of measures. We know there's more that we can do to help. We know that this is going to be a big transformation, and there's a huge amount of work that we need to do to go from the point where we're reliant 70, 80, 90% on the China being in supplying that volume of material for a bunch of the different materials to a point where we can really have a whole sort of domestic supply chain as much as possible in the next 5, 10, 15 years, and eventually get to a point where we're far less dependent on a country that is hostile. So it was again, it's at that level in the U.S. government in terms of how important an issue sort of taking China out of the supply chain is.
Nationalization light. No, I'm joking. That scares people. Those sorts of sentences. But
no, there's none of that. There was no talk about that, thankfully. So yeah.
No, I know. But what, I guess what I'm trying to get a grip on, because we talked a few weeks ago about the potential for some of these projects to be either entirely debt funded or provincial or state funded to a level where they can get into production and maybe even eradicate the need for equity, at some point down the line. That's why I'm sort of intrigued by the nature of these conversations. Obviously, the South American story, is about taking over assets, taking over the company, and that's not very good for publicly held companies. But with this kind of light touch from governments, and let's focus on the US here, they're concerned about critical minerals pathways, supply to meet, national demand. Given how small the mining sector is, given how small in relative terms some of the funding required to get these projects into production to deliver against those needs, do you see governments sort of more and more stepping up to the plate as you recently announced with the Canadian government's tax credits? Can you see that in the U.S.?
Oh, I think the U.S. is there, and then the other part is because of the way the legislation is written in the Inflation Reduction Act in terms of, sort of friendly countries qualifying for, participating in those subsidies. Again, I think the realization is, there's not going to be 100 mines open up in the United States in the next 3 years. They have to fix the permitting process to make that happen. But what they are doing is basically creating a much broader alliance. So I think what you'll see over the next 6 months to a year is basically the sort of friendly countries with the U.S. will all sort of become part of this ecosystem around how we with a shared interest of not having China in their supply chains. It'll be interesting to see how that all evolves going forward. So
that's specifically talking about the IRA there, obviously. But I guess what I'm getting at is, does it feel like there's more initiatives coming down the line, will this get easier for mining companies to access capital?
Yeah, no, 100%. Like they they're there to basically find ways to whatever it takes to get as much of the supply chain built in friendly hands. So yeah, and yeah, so if there's a market disconnect that continues to sort of impede that, then again, I think they'll throw more money at it. Like they are really committed to whatever they need to do to get the incentives for the market to come and help fix this problem for them.
Right, and because we've been involved with some of the conversations with government from some of the uranium companies. About four years ago, conversations started, but it wasn't quite there yet. And most companies' CEOs said, "Well, look, it would be nice, but we don't need it. We need to be masters of our own destiny. Government moves at such a slow speed." Given the high-profile nature of Joe Biden's policies around green energy, not just green energy, but green production for the industrial complex. Electric vehicles is a massive part of that. We're seeing a huge incentive from U.S. government to help automotive manufacturers switch over and commit to that, and they've done that. Again, do you see the kind of speed and impetus of that benefiting companies, mining companies? I'm talking about today, like now, and what sorts of incentives could be there. And I appreciate what you said so far, but I'm just trying to work out where the money's come from, how it gets justified, and how does it get allocated.
Yeah, I think. I mean, I think what the Canadian government rolled out is again, I think you'll see more countries, quote, in the alliance put those kind of programs together where the one program's not giving us all of our equity, but they are delivering a pretty substantial chunk of cash, into the overall, in the overall financing mix. And again, I think if for some reason, that's still big chunks of cash don't help get over the line, I think they'll just put another layer of incentives on top of it, to be able to they'll keep doing it until they see the kind of shift that they want to have seen. So I think the key thing to take away is, that they're going to be driving for more and not less in terms of getting this happen. And as I said, there's this 5 to 7 year window here, and initially it's going to continue beyond that. But this first 5, to be some of those first projects that are able to take full advantage of these programs, I think is going to be it'd be one of those once in a generation ways to create value.
Well, I think here's an interesting, problem that they're trying to solve, which is if they don't step in and mining companies don't get into production, it's going to drive metal prices through the roof. Now, some of those problems could be designed out of cars or batteries or other use cases, but ain't going to be quick and easy. And I think metal prices then has a massive impact on, quite a bit of the supply chain as a result, which has a very negative effect on the economy. So I guess in some way they've been incentivized to solve this problem at source rather than let it ripple through with the inevitable markups all the way through that supply chain. Is that?
Oh, what was your 100%. I mean, it's that, but again, if they don't, then I think what happened with Russia and oil was the warning sign that okay, if there are countries that are not particularly friendly to our way of life, and that by leaving us 80-90% dependent on them supplying a raw material, there's always a risk that they'll just turn it off, right, and use it as a leverage point. And it's just not a good way to run an economy if you're dependent on your enemy, or perceived enemy.
Okay, well, enough of that, because what I actually want to talk about today is you've also been on the road in Indonesia. Now, a lot of inbounds talking about, well, nickels are kind of sitting duck for the Indonesians. They're going to ramp up capacity, they're going to ramp up output, in which case, the West, good luck in trying to compete with that. What did you see over there?
Yeah, so it was good to. So it was a conference organized by Shanghai Metal Markets. There were 370 people at the conference, so one of the more well-attended ones that I've been to in quite a while. And I would say 250 to 300 of the people there were Chinese or Indonesian. And then, there was other 100 from around the world. So, I think there is no doubt there is a massive amount of capacity coming. So, that one, government official talked about, there's approximately 4 million tons of project capacity that's in the pipeline, through the end of this decade. And so, that's 4 million out of what, again, I think by 2030 will be a 5 to 5.5 million ton nickel market, which is fine. Like I've been saying all along, we need all of it because people are underestimating how much demand growth is coming. So, that capacity is coming. There really is a real focus on creating a battery ecosystem within Indonesia. So there's much less talk, and this is good for people who might be feeding the stainless steel chain in the United States and Europe. It is all of the projects, the HPAL projects are going to be much more front and center, and they'll be producing MHP, which will go into the battery chain. There's no talk about any more stainless capacity coming on in Indonesia. So I thought that was pretty interesting structurally. The key thing though is, again, coming to supply concentration, by the end of this decade, you're looking at Indonesia being 75 or 80% of the global market in terms of production. So, one of the interesting takeaways was, there's been some talk about floating the export tax on NPI to force even more downstream processing in. But what there was a lot of discussion in the government talking about is creating an Indonesian nickel price index. And so, that would be the basis for which Indonesian nickel materials at various forms were going to be priced off of. So that, to my mind, is also a way that if they wanted to basically just, effectively manage the price higher, to make sure that Indonesia is capturing the most value and the Chinese capturing less. I think once we get through this next wave of capacity additions and the Chinese have invested, another 30 or 40 billion dollars in the country, I think you'll see it where they, again, for utilizing the resource, which is limited, right? It doesn't go forever, that they make sure as a developing country that they're getting the most value for it. So what that means is for the rest of the world, that there's a risk, that they're going to try and move prices higher, as part of all that. So it'll be interesting to see how that plays out. And that should sort of get a little more clarity on that. I got a sense that in the next 6 to 12 months, we'll see something on that for sure.
Right. So lots more capacity coming down the line, potentially China financing a chunk of that, Indonesians wanting to take control, to create their own, I guess, OPEC. In fact, you've got a name for it, haven't you?
ONEC. Yep.
ONEC. Which will be really, really interesting to see if they corner that, but also interesting to see how the West reacts to that, because I guess there's some legacy issues around environmental and perception of just how green that process is. And the automotive manufacturers, as part of their marketing, their branding, are maybe concerned about that. What does that do, or what's the opportunity there for kind of Western producers to kind of slot in there?
Oh, for sure. I mean, and again, that's part of, our thesis has always been is, again, even if Indonesia, becomes the dominant supplier, Western companies will want some amount of local supply. So, the discussion we just had in the first 6 minutes of this call, they don't want it to be in a country or controlled by companies that, could potentially threaten the economy of the United States and other Western countries. So big focus by a lot of the automotive supply chain to have domestic supply, or as much domestic supply as possible, is not going to go away anytime soon. However, there is a market reality. We're not, production's been shrinking in the West. So, I think there is going to be some interim measures and some small amount of U.S. involvement in Indonesia to try and get the material they need in the meantime before Western projects can come up. But no, the challenges there. It was very clear. I'm going to do a little extra work, but it seemed that there was a lot of open property. So again, with a laterite mine, you're just stripping the first X meters of the soil off the top of the underlying rock, and so it looked like there was large open areas that had not been revegetated. So typically in a well-run operation, you mine what you want, then very shortly after you go back and revegetate it, which keeps the rest of the soil in place and eliminates any runoff and so forth that could degrade the areas around it. from what we could see from the highway, from the mines that we went in, I was surprised just how much had not been revegetated yet. And again, that just creates runoff that goes into streams, that goes out into the ocean. The other big challenge, the other issue that I think is going to be challenging for Western companies to get involved there is, every plant had what's called the BRIMOB. I'm not sure if I'm pronouncing that properly in Indonesian, but these are the badass Indonesian special forces. These are not your sort of security police. These are, anti-riot, anti-terrorist, top elite forces within the Indonesian government, within the Indonesian armed forces. And they're there because, there was a big riot a few months ago at one of the plants. And so, we've been told now they've got these guys at each of these facilities. So that's not, I would say, leading labor principles in terms of how you manage your workforce. So guys with very, very big guns.
Yeah, and I think that sort of thing, and obviously run off into the oceans is sort of making negative headlines across the board, and broad brushstrokes are being applied. But I guess that'll become clearer, and companies will do better at kind of communicating, where they stand on those sorts of processes. And just talk to me though, if all of this capacity is being created, right, 4 million tons, through 2030, they're going to need to feed that. You're going to need to feed those plants. So there's no point in having capacity if they're not optimized. But what's grade doing over there at the moment?
Yeah, that's the single biggest risk to the story. And then again, for the opportunity for the rest of us in the rest of the world is, in terms of the volume of material, what was interesting, the guy who was the head of the Geological Bureau, in his presentation, that 4 million tons of capacity will need 500 million tons of ore per year. And he's not sure that, the resource base in Indonesia can support that level of operation. There was something I was keeping an eye on it and focus as we went to the different operations. What was very clear is the ones on in the island of Sulawesi. They were designed initially with 1.8% feed, and that would generate for one size furnace about 8,000 tons a year. They're now, some of those operations are at 7,000 tons or even a little bit less, because the grade that is going through, a couple of plants was at 1.65 or 1.6. One of the operations said they're already using 1.5%. So, again, the Chinese have, they've basically optimized this process to the extent, you're not going to try and get more throughput through these furnaces, that's designed. So any loss in grade comes right through with a loss in output. So you might build 4 million tons of capacity based on a 1.8% grade, just a simple example. But if you get a 1.6, that, there's 400,000 or 500,000 tons less production that's going to come out of it. So, that's some, I think in some of our discussions, I've talked to the Nickel Industries owns some mines in Indonesia, and they publish the ore grade. And you've seen from 2% grade when they went public in 2019, their mines are already down to 1.65, 1.7%. So, that's something to definitely keep an eye on. Now, the HPALs don't use the saprolite ore. The saprolite ore is for nickel pig iron. There's lots of limonite around. So, they won't have any problems for the first 1 million tons or so, or probably first 1.5 million tons of HPAL production, because they'll be utilizing material that's, being already mined. But, it'll be beyond that, then that next 1 million tons or so, we'll have to see what happens with those grades as well as we move forward. So I say, that's a key risk and a massive opportunity for those in the West, who will have nickel resources coming to market later this decade.
It's been interesting. It's obviously with this new build out, coming through at high speed. It's I know there's lots of Indonesia, there's lots of islands and lots of locations, but I wonder how much monitoring will be done. Surely automotive companies, I'm not talking stainless, I'm talking just automotive companies, will demand that level of, I guess, oversight or certification to, authenticate with whoever they deal with. Indonesia feels like that's kind of behind a closed door in a way. I know you guys were on a site visit there, but how open are they?
Well, they've been pretty good. There are I think, we do get to see, that production data, but part of me can't help, that where there's talk of large nickel surpluses, and yet we don't see a lot of inventory sort of laying around. It doesn't feel like we're in a massive surplus situation. And again, yes, stuff can't. There's a lot of stuff that's not LME deliverable but I think for one thing, several sources said that DeLong, who's the second biggest, behind Tsingshan in Sulawesi, that they're in real financial difficulty. That they've stopped producing stainless steel, and they're really struggling to remain profitable. So if there are companies like that, they wouldn't be in non-transparent economies. It's not unforeseen that they may not be counting their production exactly, and maybe overstating it to try and make their numbers look better than they actually are. So again, time will tell. We'll see what happens as the course of the year goes, but it'll be really interesting to sort of see how this ramp up continues.
Well, yeah, and I imagine the Japanese and Koreans keeping a very, very close eye on that. Indeed. Well, let's just talk a little bit about the market, the macro, and get a recap of the numbers. Where do you see this going?
Yeah. So again, we've settled in. I thought with the debt deal, again and the negative things on global slowdown, we might see a test of $20,000 a ton or $9 a pound. But no, we've basically been, hanging in there either side of $21,000. Again, on the inventory and quote surplus that's out there, we've seen LME inventories continue to creep lower, down to 37,000 tons. Now, China got a whack of Russian material this week. So, we'll see how that flows through the Chinese market, whether that takes some of the premium steam out of there. But again, I still think if we get some negative news that we could see a test of below 20, but so far hanging in very nicely at that $21,000 level. As we've talked about the last few weeks, as I said 4 or 5 months ago, we're going to see lithium prices, basically cause this massive destocking in the battery supply chain. And then we're going to see this face ripping restocking happen on the lithium side. And again, lithium prices were up more than 13% week over week. And in conversations in Indonesia with people said, yeah, no, there's the whole battery supply chain is really starting to restock. And again, sort of this great convergence happening now as enough material is able to be used by the battery supply chain, and not be forced to be pumped out to the market as nickel pig iron. So again, sulfate prices, have moved up when LME prices came down, and so the discount now is less than half of where it was just 6 weeks ago. So this convergence trend is continuing to come, and again, the stainless market, China overall economy is not great right now, but even with that, we saw NPI discounts again squeeze in. So we are headed down the right path. It's going to take another 6 to 12 months to unfold, but we're on track for that great convergence. Happening. Okay,
so what's happening out there in the battery world? Because obviously we're covering the whole sector, but in terms of the section that says a little bit of it, in terms of battery restocking, what are we seeing?
As lithium prices were collapsing, basically Chinese supply chains are very, very good at running inventories down to a really low level. And again, until they saw a bottom come in lithium prices, they were basically only ordering the absolute minimum that they needed to order. As soon as we saw that bottom get put in, you see a whole flood of orders come into the system and start, and so we've seen that, basically lithium prices come right back up. And again, we should see improving demand conditions for nickel, cobalt, graphite, the rest of the battery materials that are used alongside that lithium.
Okay. Interesting times. We keep monitoring and keep sort of checking in on the price. Your general sense is what for this year? What are the things that you're going to be looking at this year to kind of give you confidence that the uptick is on its way?
Yeah. So again, the trend in lithium prices is good. We'll need to see stainless prices move higher. And again, I think we'll see stainless and the battery raw material prices continue to move higher. When you have a really high underlying demand growth rate and you have a destocking, for that restocking to catch up to something that's growing quickly, it can be a really sort of intense, restocking phase. And I think, the same trends that I've been seeing for the last few weeks, basically, if that continues on, I think that does set the stage. As I said, at the beginning of the year, we're going to go through a big patch of softness, but by the end of the year, the growth in the battery market should assert itself across the, it's going to be intense enough to really have an impact on the broader nickel market per se. So.